you don't want to be on the other end of that trade where you suffer while the U.S. government gains. So I would replace what would normally be bonds in the portfolio with higher dividend paying stocks to get income, maybe some precious metals again for stability and safety. And to the extent that you're going to be in bonds, I would prefer some of the emerging market currency denominated bonds where I think there's upside in the currency. And a lot of those bonds, the yields are, they're not great historically.
What percentage of the portfolio should go to gold?
Yeah, well, the problem with bonds, as an asset class, bonds have a solid place in a portfolio. The problem is you really can't put them in a portfolio in any meaningful sense now because bonds are so overpriced pretty much all over the world. So you get tremendous risk in these bonds because there's the risk that interest rates go up, in which case the value of the bonds goes down, but there's the greater risk of inflation, which destroys the value of the principal when you eventually get repaid, and also destroys the value of your dividends. But those dividends are rather interest, but the interest is minimal. If you buy bonds of decent credit quality, you barely get paid. And in fact, you have sovereign debt with a negative yield. Why would you buy a bond where you have to pay the issuer for the privilege of loaning the money? It makes no sense. So unfortunately, you can't have bonds. And in an inflationary environment, and we're certainly in the early stages of one of the things that happens is that there's a big transfer of wealth from creditors to debtors. The debtors benefit from inflation at the expense of the lenders. So you don't want to be a lender when there's a lot of inflation that is not already anticipated and built into the price of bonds. Now, of course, the biggest debtors on the planet are governments, particularly the U.S. government. And so the U.S. government has a vested interest to create inflation because it benefits from inflation. And in a number of other ways, it benefits from inflation. And negative interest rates are extremely bullish for gold, even if those rates become less negative, which is what markets expect. But I actually don't even expect that. I don't believe the Fed is going to fight inflation. If they tried, they would lose. I think they're just going to surrender. I think the idea that the Fed is going to start shrinking its balance sheet is fantasy. Even if it starts, it's going to stop and it's going to blow it up again, just like it did before. They started the taper when the balance sheet was $4.5 trillion, and they tapered it down to a little under $4 trillion. And now where is it, $8 trillion? What difference did the taper make? And let's say the balance sheet grows to $9 trillion, and then they taper it back down to $8 trillion or $7.5 trillion, and it blows up to 15 or 20 trillion. They can never stop this monetary policy. We're addicted to this monetary heroin. And whenever the Federal Reserve tries to even lessen the dosage, the economy goes into withdrawal. Asset prices start to fall. The economy starts to move to recession. And now there's, everybody wants more drugs. And so the Fed accommodates. They come back. Oh, we got to cut rates back to zero, even if they raise them. We need more QE. We need more stimulus. And so when the markets understand that there is no exit from this policy, that it's QE infinity, that it's negative interest rates as far as the eye can see, the price of gold is going to go way up. But before that happens, people who are smart should be buying now. And if they have the risk tolerance and they want to really make a lot of money off of this, they should be loading up on these gold and silver mining stocks. We had managed portfolios here. I have a strategy where we manage for people all around the world of gold mining stocks. We have managed accounts. I also manage a mutual fund. And you have so many people who are bearish on gold. The conventional wisdom is that gold's going to go down. And so why would you want to own a gold mining stock? And so these stocks are historically inexpensive, both relative to the price of gold, relative to their own earnings, and relative to the stock market in general. So, historically, this is a gift when it comes to these stocks. And the reason that everybody is so pessimistic on the price of gold is that they expect the Fed to raise rates, which of course, they're at zero. So you would expect at some point they're going to raise rates, and that they're going to, taper their asset purchase program, so tighter money policy. And all of this is assumed to be bearish for gold because historically, a tighter Fed is not good for gold, right? Gold wants loose money. But the reality is, even if the Fed tightens, we're going from excessively easy to just slightly less excessively easy. Even if the Fed raises interest rates, they're not going to be positive. You don't want to be on the other end of that trade where you suffer while the U.S. government gains. So I would replace what would normally be bonds in the portfolio with higher dividend paying stocks to get income, maybe some precious metals again for stability and safety. And to the extent that you're going to be in bonds, I would prefer some of the emerging market currency denominated bonds where I think there's upside in the currency. And a lot of those bonds, the yields are, they're not great historically, but the yields are quite a bit better than what you're going to get in the major currencies, like, the dollar, the British pound, the yen, euros, Swiss franc, the Scandinavian currencies. I mean, these currencies have no yield at all. I think the mining stocks are the real opportunity. They are super cheap because the mining stocks don't just reflect today's price of gold. They reflect what people believe tomorrow's price of gold will be.
What to expect from stocks going forward? Is this stagflation, which macroeconomically, I agree with you, it's more and more what happens. There is a shortage of everything and companies are left with increasing prices, and this will perhaps at one point bite the demand side. But the question is, what do you expect, how it's going to impact global stocks, within the next 6-12 months?
You didn't see that big a nominal decline, but obviously adjusted for inflation, the real returns on stocks were negative. In fact, most of the returns came from the dividends because the real price of the stocks went down. Of course, depending on dividends today won't get you very far because U.S. stocks pay very low dividends. Many of the most popular stocks don't pay any dividends at all. So if you're going to be, banking on dividends for your returns, there's not much here. But I do think that since this inflation is going to be much worse than it was during the 70s, you may see a better nominal performance in the stock market. Those stocks can still fall a lot in nominal terms, but I think, real businesses, with real assets and income and dividends, I expect those prices to go up. But I do think that relative to gold, for example, 10 years from now, the U.S. stock market will be substantially lower than it is today, regardless of what the price is in dollars. If you try to price it in gold, the market will be considerably lower than it is today. And I think that will probably be true for most commodities. I think if you price the Dow in wheat, soybeans, copper, oil, I think the Dow is just going to be down. I think only when you're pricing it in fiat money, in dollars, you might see a higher price. So I think that this is going to be a decade for commodities, for real assets. And to the extent that you're in the stock market, it's going to be the emerging markets that are going to dominate, not the developed markets.